Hello, I'm Michael Blayney, Head of Multi-Asset Investments at Pendal Group, and today I'm going to provide you with a brief update on our views on portfolio construction and current market conditions in light of the volatility that we are experiencing. The first point is it's always important to maintain a diversified portfolio. And there's multiple ways in which people can diversify their portfolios. At a basic level, it's having both equities and bonds, but also within equities to have a blend of Australian and global equities, because even though they might move together on a day-to-day basis over an investment time horizon of a balanced investor, which would be 5 years or more, they can provide substantially different returns over those longer-term time horizons. In addition, it helps in a portfolio to have some alternative assets and also some foreign currency exposure. The foreign currency exposure is usually achieved by holding a reasonable proportion of the global equities on an unhedged basis. In the first part of the recent market correction that we have had, we saw that bonds provided nice diversification to equities, with yields falling at the same time that equity markets were falling, resulting in capital gains on government bonds. In the most recent leg of the market sell-off, we have, however, seen bonds and equities providing negative returns at the same time. Now, the key thing about portfolio diversifiers is that they don't necessarily always diversify in every market condition. So it's important to have more of them. And that's why, for example, foreign currency has been extremely valuable because the Australian dollar has continued to depreciate, and this has helped to cushion a portfolio. In addition, alternative assets can provide a degree of portfolio diversification as well. Now, we've seen mixed performance from alternative assets in the large sell-off that we've had. However, even where negative returns have been achieved by the alternative assets, they've generally been better than equities. So if you put together a portfolio of equities, bonds, alternatives, and some foreign currency, that has smoothed the path of returns, even if they're still negative, for an investor. We also note that in the current environment, spreads on corporate bonds, which are essentially the excess yield that a corporate needs to pay to borrow in excess of the government, those spreads have widened quite a lot. We now have spreads on investment grade bonds, if you look at the US corporate index, of approximately 285 basis points. High yield spreads also widened considerably. Now, if we look at the long history of investment grade bonds, even through world wars, depressions, recessions, and financial crises, default rates on investment grade bonds tend to be very, very low. So the spread that you get on investment grade bonds is largely compensating you for illiquidity risk. And that's a big part of the reason why spreads have blown out so much now. So whilst we may see some defaults come through, particularly in the energy and leisure sectors, the current buffer on offer on investment grade bonds well and truly compensates for even an adverse default cycle. If we were to, however, look at high yield bonds, the default cycles there can be significantly worse. And if we see significant defaults on energy, which represents a reasonable portion of the high yield market, then the current spreads on offer might not yet be sufficient to compensate for that. So we prefer investment grade exposure in this environment. Now, we also note that whilst earnings and dividends will take a hit, the current market reaction has exceeded where we believe the impact on long-term valuations should be. So we think it's probably about double that impact. Now, of course, coming into this, some markets were very expensive, for example, the US, whereas a lot of Asian markets were already actually reasonably undervalued coming into this crisis. And so some of those markets do represent extremely good value in the current market environment. In addition, once the crisis eases somewhat and investors start to look around for ways in which they can generate returns on their assets, 0.25% official cash rate will most likely not be a particularly attractive return. And even though we are likely to see dividends get cut on shares, the dividend yield on shares is likely to be significantly better than that very low cash rate. And yields on corporate bonds, in particular, investment grade, given those blowouts and spreads, are also likely to become attractive to investors again. As a result, we believe that in this environment, it's what investors should do is stay diversified, increase exposure where appropriate to particular circumstances of that portfolio, and to very much stay the course and not to panic. As we know that whilst it's impossible for anyone to predict the exact bottom of a share market, if people do bail out after very large falls, that tends to be quite destructive to long-term wealth. We know that it's far better to stay the course with a well-diversified and well-designed investment strategy.